Hello and welcome to Financial Accounting with Anne Marie Anderson. Today we will do a little exploring on the topic of short-term assets. First, a definition. Short-term or current assets are those that can be sold or liquidated to raise cash in a short time, usually a year. Let's start with some of the most common short-term assets. The most liquid asset is cash, no surprise there, but it's not just cash that falls into this category, also something called cash equivalents. A cash equivalent is a short-term, highly liquid investment that can easily be converted to cash. Examples include marketable securities, treasury bills, and money market funds. To the next common short-term asset, accounts receivable. Accounts receivable is money owed to a business by its customers for goods or services it has delivered but not been paid for yet. Let's look a little deeper into goods versus services. If you are selling products, then the sale is complete and money is due to you once those goods have been delivered. That money due to you is an account receivable. Alternatively, if you have a service-based business, once you have provided the service, an account receivable is due to you until the bill is paid. Some typical service providers could be accountants, lawyers, architects, and even caterers. The journal entry is a debit to accounts receivable and a credit to either sales revenue if you're selling goods or service revenue if you provided a service. Moving on to the next asset, supplies. Supplies are tangible items not intended for resale that a business consumes in its day-to-day operations. These are things like pens, pencils, cleaning items, paper, and even packing materials. The journal entry for supplies is a debit to supplies and a credit to cash. Inventory is a big one, and there's a whole series of videos just on this topic. Inventory is a company's goods and products that are ready to sell, along with the raw materials that are used to produce them. There are three categories of inventory when your company is making the products: raw materials, which are purchased to make the product, work in progress for the items being made, and finished goods or the products ready for sale. The journal entry to buy materials is a debit to inventory and a credit to cash or accounts payable. Next asset, a prepaid expense or prepaid asset comes about when an expense is paid for in advance. Some common prepaid items that might be paid early are rent, subscriptions, and even insurance. Let's go through a quick example for prepaid rent. Let's say Julian just rented a chair in a salon for a year and he had to prepay rent of $12,000 on January 1st. The journal entry would have been a debit to prepaid rent and a credit to cash on January 1st. That $12,000 of prepaid rent covers the whole year though, so how does he spread that rent over the year? Well, we do it with an adjusting entry, which we do at the end of every month to show that we used $1,000 of that prepaid rent until it is all used up by December 31st. The monthly entry is a debit to rent expense and a credit to prepaid rent. Classifying assets as short-term is important because it shows how easily a business can pay its bills and keep running day to day without running out of cash. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.